Hello and welcome to this new edition of the Monday, July 20th report from Bourdieu. The economic statistics released in the United States last week were numerous and overall rather satisfactory. For example, it is worth noting that small business confidence provided reassurance by rebounding more than expected in June, just as consumer confidence also rose more than anticipated in July. While consumer spending remains resilient, as shown by the increase in retail sales in June, residential real estate continues to struggle. Developer confidence is declining and the number of new building permits is contracting. But the most important publication of the week was the release of the Consumer Price Index in the United States. As shown in the chart, consumer price growth slowed more than expected year-on-year in June, dropping from 4.2% to 3.5%, thanks in particular to a 0.4% decrease in prices in June. Core inflation also decelerated from 2.8% to 2.6% year-on-year. This is more than anticipated. This good news is further confirmed by the slowdown in consumer prices from over 6% to 5.5% year-on-year. Unfortunately, the suspension of the Memorandum of Understanding between the United States and Iran somewhat tempers this encouraging data. Indeed, the renewed tensions in the Middle East have pushed oil prices up by more than 15%, with Brent crude approaching $90 per barrel and WTI once again exceeding $80 per barrel. In the end, these divergent forces resulted in a 1 basis point decrease in 10-year sovereign yields in the United States and an increase of several basis points in the Eurozone. Bond prices therefore fell slightly in euros and rose even more moderately in dollars. Gold suffered from this, losing 2.2% over the week and not benefiting from the slight depreciation of the dollar by 0.2%. The impact on equities turned out to be different from previous rebounds in oil prices. Indeed, for once in such a context, European and Swiss equities posted positive performances, while losses were the order of the day in the United States and especially in emerging markets. This can be explained by the fact that the tech sector, which is heavily represented in American and emerging market indices and is usually rather uncorrelated with geopolitics, did not protect these markets this time. On the contrary, for reasons specific to the sector, these segments of the market are suffering more than others in this market phase, reminding us of the importance of true diversification within equity portfolios. This week, the economic calendar looks rather light. Nevertheless, we will have the release of the confidence indices for purchasing managers in the manufacturing and services sectors in the United States and the Eurozone. We have reinstated the Swiss company Partners Group in our list of Swiss convictions. The stock has significantly underperformed the SPI benchmark index for a little over a year, mainly due to concerns related to the group's assets under management. We were reassured by the company's recent publication regarding the current seasonal momentum, and we believe that the stock's low valuation now already reflects a lot of bad news. This is why we believe the stock should once again outperform the Swiss equity benchmark index. That's all for today. Thank you for your attention and see you next week.